Tēnā koutou katoa, and welcome here today. My name is Grant Edwards, the Vice Chancellor at Whare Wānaka, Aoraki, Link University, and it's really great to see you here to this Link University's Excellence Series. This series shines a spotlight on our most impactful researchers, celebrating academic leadership across disciplines and showcasing the applied research that sets Lincoln apart. Today, we're pleased to welcome Professor Christopher Gann, a renowned expert in banking, microfinance, and Asian financial economics. Professor Gann's research is both rigorous and practical, blending quantitative analysis with real-world application. His work has informed policy and business decision-making across Asia and in New Zealand, particularly in areas such as rural credit, financial markets, and the evolving role of banking in their modern economy. In this afternoon's talk, Professor Gann will delve into the unique role of banks in supporting economic growth, financial stability, and liquidity. Please join me in welcoming Professor Christopher Gann. Thank you.
Thank you, Professor Edward, for the introduction. Good afternoon, ladies and gentlemen. This afternoon, my presentation is going to be on why banks are unique, why banks are special. When Katie approached me, say, oh, we would like you to give a seminar, I was like, are you serious about it? And she said, no. So I was thinking, what should I present to the audience? And I said to myself, maybe I should do the good, the bad, the ugly of microfinance. Then I say, no, let me go something that's more practical, that all of us are related in our life, banks. So why a bank unique? Why a bank special? I'll walk you back to some historical development of this topic. When we look at bank in the early 80s, 70s, 60s, 70s, early 80s, we have what we call the Chinese War in banking. Then we had the bulls in banking. Then we have the dialectic struggle in banking. These three together make bank unique and special. So I have given several seminars related to this topic, and I asked my audience, do you like your bank? Do you love your bank? And my audience say, I don't care whether I like or love my bank, but I trust my bank. That's where we go, okay? Now that's okay. So the Great War of China, we understand what is the Great War for. It's to fend off your enemy. So mathematically, it's a symbol that our banks in the early 60s, 70s, and perhaps early 80s are highly protected. From who? The bulls. Who are the bulls? We'll come to that later. So when you look at this war over the years, it has been making, when the banks are highly protected by this war, they are very dominant in the landscape of banking, in the financial landscape. If you've been to Asia, you've seen most banks in front are two lions, right? What is a lion symbol? King of the jungle. That's what they are. Even today, you go to Asia, there's still a lion there. They still believe that they are still the king of the financial market, the landscape, right? So when you look at the banks here, they are protected from the non-banks, the non-financial institution, right? So the metaphor war means they are, in order for you to get into the banking business, you must apply for a charter. It's not like any other business, you can go apply for a license. You have to go through a lot of due diligence by the central bank. Because why? There's a lot of implications behind the word trust, right? And because they are protected, they get the what they call a cushion from the central bank if they fail. They get access. Central bank, we define it as a lender of last resort. Banks goes, they get bailed out. A firm fail, they liquidate, they close shop. As simple as that. And bank has the way of lobbying power for a lot of protection against other players, right? And also customer data are locked in and all kinds of advantage. This protection allowed them to dominate core area like retail lending. We have your payment, deposit taking, mortgage. This is where the bulls want to get in. This is where the other player want to get a piece of the pie because the bank dominates them, right? Now, we have the bulls. These are the non-bank players. They are very different from your bank because why? They are not regulated like the banks. Banks are highly regulated type of entities. I will tell you why later on. Regardless of what we say, today they are still highly regulated. That's why when I ask you, what do you think of a bank? I don't care whether I love my bank or like my bank, I trust my bank. Non-banks such as fintech, big tech, peers, and so on, they are trying to break into this war to get a piece of pie, especially in the mortgage, especially in lending, especially in credit card, right? And the problem with the bull is that because they are not regulated, they are very innovative. They are very aggressive. They will try all ways to break through the wall to take your business, my business, right? They operate outside traditional bank regulation like insurance company. They are only regulated by the insurance commissions and so on, stock market by the security exchange, but not by the central bank, right? And they are able to cut costs, so give you better service. Banks are not able to do that. And they push for open banking, decentralization, access to the banking infrastructure. So you have the war, you have the bull, keep knocking, keep knocking, keep knocking. Sooner or later, the wall will crumble. But what gives rise to the fall of the Chinese war in banking? And this is where we come to the dialectic struggle. I'm sure some of you are familiar with this dialectic struggle, especially when you have children. When they're young, you like to regulate them. But the young one like to do what? They do not want to be regulated. They want to be innovative, all kinds. So you give them the freedom, they abuse it, you regulate them. Banks are same. When we regulate bank in the war there previously, they are comfortable sitting behind. When the bull keep hitting in, then they felt that, wait a minute, the bulls are not regulated. They can do anything they want. We are protected, but we are constrained in making money. So regulation Q is a good example in the early 80s where banks cannot determine the lending rate or the saving rate. They have a ceiling, they have a floor set by central bank. So over the years, bank been arguing to central bank, please set us free, please set us free, let's compete. The wall broken, right? Let them compete. So you deregulate them. And here is where the bank argue we can compete. So what do you do? Once you move the restriction, what the bank do? They innovate. They take more risks, which sometimes they should not be doing because why? Bank does not have comparative advantage in many things that non-banks do. So what happened then? You open the market, you allow them to compete, they don't behave. So what you do then? You re-regulate them. This is when you have all the financial crisis, the Mexico crisis, the Chile crisis, and then you had the Argentina crisis. Don't cry for me, Argentina. They really cry for you. Then you have the other one called the Asian financial crisis, 1997. They call them the Tong Yam Goong crisis. Then you have the latest one, 2008 global financial crisis that caused by the US subprime loan crisis on the housing market. You ask yourself, you regulate them, they complain. You remove them, you allow them to compete, but they don't behave. You re-regulate them and your financial crisis, but you still survive. That's where the uniqueness comes from, because why? They've been bailed out, right? So this is where we always have that. When a crisis comes in, central bank, government authority re-regulate what bank can do and cannot do. The landscape change again. After a while, relax them, they play in there again, and they get more innovative, take more risks, few more problem, right? This is the problem with that, right? What makes bank more than just ordinary business? A bank are not just profit seeking, but they are your publicly significant institution with systemic importance. This is the keyword in banking that make them unique and special. What does that mean? So I ask you today, you are a competitor. You list in the stock market. Your competitor fail. What do? You laugh. Great, less people in the market now. Let's go for it. Now let's take the bank. Westpac Bank today fail. I'm ASB member, TB Bank member, ANZ member. What do? You sit down and say, hey, Westpac Bank fail. No, you run to your bank. You say to yourself, my bank can fail too. So you withdraw your money. That's called bank runs. This is the problem that we expect a lot. And that's why we say to ourselves, we still trust our bank in spite of all this, because why? The central bank and the government and monetary authority will not let bank fail, because the bank carry three significant metaphors in the whole of our financial landscape and business landscape: safety, soundness, stability. These three key areas are heavily governed by central bank and government authority because of bank run, right? Last year, we have the Silicon Valley Bank in California. It went to trouble. Straight away, central bank intervened, clean them up, merge them up, and let the system go, because you worried about people start withdrawing money from other bank, and this is where it's very crucial. It's almost same like the Evergrande problem in China too, where people money in the bank are suddenly very shaky. They start withdrawing. Central bank come in to calm the situation down so that it don't spread to other bank, right? So what's the core function of bank? Take your deposit or make money. The key is loan and credit. It facilitates our payment from overseas, local, and so on. It acts as an intermediary. But the uniqueness of bank comes from these two sides: deposit and loan. Now you think about it, this is the balance sheet, the ledger. This part of the ledger is very liquid. Deposit. People can withdraw their money anytime. That's why banks need to stay liquid. This part of the balance sheet is illiquid. Long-term loan have maturity. So you have a mismatched maturity. And the problem with this one is that it's getting less and less in the bank. Why? Consumer has a substitute now. They don't have to put the money in the bank if you don't give them good interest. They go out to the market. And banks are fighting for that, you know. So in order for bank to make money, before I took a course in banking, I thought that the way to make money is just go behind central bank and print money. Now, like then when I took a course, we went to North Carolina, the district central bank. So I tell you a story. Early morning, we went for a field trip, went to the bank, coffee, donut, it's great, you know, for students. That's the best breakfast you have for sugar. The director explained to us about the nature of the central bank in US and the 12 district central bank, and they wanted the district. So we talked a lot, and they took us to the bottom. That's where they print money. As a student, our eyes like millions and $1 million to print, like our mouth was saliva all dropping down. Like, God, man, what is this going on? That's okay. He took us in another room and he hauled a bundle of cash. So we asked the director, why are you doing that? We're going to burn them. We tell the director, oh, don't, we'll take care for you. You know, we will clean up for you. Don't worry, you don't need to burn, save money. No, I burn $1, I print $1. Because if you don't, you're going to do what Argentina did, Mexico did, hyperinflation. It's like about almost 2,000 inflation, just like Zimbabwe did. It's the same thing when I took my student to Thailand to the central bank. The central bank in Thailand do not burn them. After our visit, they give us a bundle of cash, but they're all shredded. The director say, this is a jigsaw puzzle for you. Piece up together, you have your Thai baht. I'm like, oh, we will never find the answer. The center director bank say, that's why I give it to you. All right? So that's the nature of it. The unions come from the dual role. Bank is out there. You ask any major bank manager, what is their objective? Maximize shareholders' wealth. Simple. But they also have a public side, the trust. That you and I, in spite of so many financial crises today, you still put the money in the bank. You still trust the bank. And that's why the central bank and the government cannot allow bank to fail, because why? There is a built-in trust in there, right? Now, similar to this, even microfinance has a dual objective. Microfinance is out there to make money, but microfinance has a social objective. That is poverty alleviation. So you see the Uniqueness Bank, besides making money, they had to protect this side of the coin, instill your confidence in the system, right? Money creation through lending. I lend you money, you take your money, deposit in another bank, and expand, multiplier, right? So it's not like when I was a student, how you make money in the first exam I have, I just put down there, central bank print money. I get back my exam, I get a big egg from my professor, central bank make money. No, it is through lending where the money multiply. It depends on the required reserve by central bank, right? Central bank impose a required reserve on deposit. Every deposit come in, let's say it's 10% today. $1 come in, 10% stay in your bank as cash, so 10 cents. You have 90 cents to make loan. But on your liability side, you had to pay back your depositor 100%. Very constraining, right? Why is the purpose of taking that 10% out from the $1? Because the left side, no, the right side of the ledger is really liquid. You and I can withdraw, close our saving account, deposit account anytime. In the loan side, borrow don't come in. Hey, bank, you're losing money here. I run the write off my loan. Never. You only go in your bank to rewrite your loan when the interest rate go down. Interest rate go up, you don't even visit your bank. That's the problem, right? And the problem with bank is this: high interest, you attract saver, no borrower. Low interest, less saver. A lot coming to your bank to borrow money. That's the problem with that, right? And also they are very highly regulated, like I say. And most central banks are independent of the government. They make the decision, right? Systemic important, we talk about it. Bank, man. So I ask you, do you trust your bank? All of us bank today, right? Correct? So we trust it. But it have a key economic policy in terms of money supply, how you multiply money supply in the country. Central bank do not print money just for the sake of increment supply. We increase money supply through required reserve from our people here, discount rate, where bank borrow from central bank, or open market operation. Government treasury buy back the security from you and pump in more money into a system, allow it to expand, right? So Bank and economy, they're the architect of economic activity. They have the power to accelerate recovery, sustain growth, and amplify crisis. And the problem, why do we have financial crisis? Because banks had to compete with non-bank. They are regulated. So what do? They innovate. They have to find way to survive. Innovate means taking more risks, especially in the early 90s when banks start moving off balance sheet. Anything on the balance sheet is regulated by central bank. Anything off the balance sheet is not, like letter of credit, loan guarantee, taking your housing loan, taking your credit card loan, sell it in the security market, make more money. All those money come back into the bank balance sheet. They are not regulated. They don't have to put 10% of required reserve. So to give you a good example on this one is that the housing market in US is a good example. In the early 2010 or so, interest rate was very low. So what do? Financially say, spend, not save. So what did the Americans do? Buy a house. House is a good investment. House is a collateral. What do banks do? Lend to you. Because why? House is a collateral. You don't pay me back, I take back your house. But the problem is that during that time, because the banks are so aggressive in selling housing loan, they need money. So they sell off of this housing loan in the secondary market for everyone to buy, including OC banks like Bank of China, Iceland, Northern Rock in London, and so on. So what happened then? Everyone in US have at least 2-3 houses. We're supposed to buy a house for what? To live in. But during the era, people buy a house to speculate like stock market. And that's the problem, because why? They buy a house, they hope in 2 years' time, I can sell my house, make more better money. Interest rate comes in, borrower default, can't pay. No problem. House with me. But the problem is everyone who owes 2-3 houses so default, suddenly banks are stuck with a lot of house and they cannot sell. But the loan value does not go down. Loan value is keep climbing up. Cut the story short, that's where the crisis came in. Then what happened? Central bank regulate again, and now making the off-balance sheet to be contingent on a liability on the balance sheet to protect this type of behavior, right? So money circulation, liquidity, monetary transmission, these are what banks act as to create money in the country, right? During inflation time, during recession time, and so on. And it's also a source of its stability in the country. You know, banks are important, but banks can also cause instability in the financial market, financial system, which we have seen many times already. You also have a national goal for development and interdependent with other sectors, like all our payment now are through our bank account and so on, right? So public trust and confidence, it comes from our deposit side. You know, when I teach this course, a lot of my students always come and ask me, you know, what should I do with my money and so on? You know, I tell my students, if I know that, I wouldn't be teaching you. I'll be out there making money. You know, it's like, what do you mean? I say, at first I'm a student, are you a risk taker? Maybe, maybe not. Then you should park your money in the bank. If you're not risk, if you're a risk taker, then you play in the stock market then. It's almost like casino. Do you win? Casino let you win for a while. After that, they make sure you lose everything back to them. But the problem with the bank is that we trust them. Why do we trust them? Implicitly or explicitly, most banks are bailed out by central bank. Government do not like bank to fail. They either merge them or acquire them, right? So we have that trust, stability, safety, soundness created by the bank, right? When there is a loss of trust, it's a contagion effect. And this is very crucial during the 1997 financial crisis that caused, in fact, civil riots in some countries, especially in Indonesia, where the central bank liquidity is zero. and the bank will go bankrupt if IMF did not come in and bail them out. Same like the Thai bank, it almost go bankrupt. If the country bankrupt, it is not just Thailand problem, it's a world problem. Central bank came and bailed them out, and this is very critical. And that's why we still trust the bank in spite of how they behave, misbehave, and so on, right? We have a confidence in our regulatory system. To some extent, I do a lot of this research, ask myself, I just finished the research on Asian financial crisis. Now we have another subprime loan crisis. I asked my colleague, they say, why you feel so sad? That's a new area for you to do research, to contribute to literature. I'm like, that's not the way to contribute to literature while people suffer. And he said, why are you worried? You find the answer. You help them to solve the problem. That's good research platform. To some extent, yes, right? Reputation, transparency. This is important. Central bank govern our banks so that they are transparent. One key thing that banks has that outside of bank don't have is their comparative advantage in accessing our information. We are all lemons, correct? But the problem, are you good lemon or bad lemon? Only bank can assess that, you know. But the problem is, bank do their homework, due diligence. A good borrower can become a bad borrower overnight because they have external factors that you and I cannot control. They wipe out our equity overnight and so on, right? And the problem with bad borrower cannot come a good borrower overnight. So when you talk about why bank is special, why we still need them, especially in lending, because they have that comparative advantage in assessing borrower credit worthiness. So I always ask this one to my student, are you willing to lend me $1,000? My student like, who are you? I don't have no trust, but to the bank, right? So then you have to think about bank is a confident game, one where trust is both an input output. Without it, our whole economic system become very fragile. Because why? As I've been doing a lot of research, a banking crisis ultimately causes a currency crisis. And that is going to hit us in our export and import, right? So then you see why this is so important, knock on wood, why President Trump is in conflict with his central bank director, Mr. Powell, because he wants the central bank to lower interest rate but central bank say we are independent of you because they have to make sure the whole system have the trust in that, right? Systemic importance, size, complexity, network decision, the failure of systemic important bank. Bank can cause contagion effect, spreading to other banks. We've seen that in all financial crises. The latest one was the 2008 global financial crisis. I think Iceland was bankrupt. It took them 2 years to recover, right? When I was teaching this one, we have some UK banker professor came in, they give their talk about Northern Rocks and all those, you know, UK bank suffering from this crisis, right? When there is a banking crisis caused by misbehavior, you have this problem. Liquidity crunch. You and I try to borrow money is very difficult, right? Like for example, in 2008 and 2009, the bank slowly recover. 2010, you try to borrow money from the bank, difficult. But bank learn their lesson, they want to stay liquid. So and they're going to affect the economic performance of the country. That business need to borrow, business need to expand, business need to buy inventory, right? So we lost our confidence system for a short while, not a long run, because why? We also say implicitly we are guaranteed by central bank. So I remember very well when the 2008 financial crisis came in, and the housing market. And we have a Reserve Bank speaker came in. I asked the Reserve Bank speaker, how likely New Zealand housing market going to suffer the same thing? He asked me, do you have to ask me this question? Yes, because we have the crisis and so on. And he gave us a picture that's a bit different. And immediately after he finished his seminar, the following day, Reserve Bank came outright and said, all depositors are protected $100,000. They had no bank run. And the unique system about this banking system in the US and UK, Germany, and also Japan, they have insurance. Your bank are insured, your deposit insured. That's why when there's a crisis coming, you still trust the bank because you're out. They're unique, special. Require government intervention bill often have taxpayer money, right? The Mexico crisis, good example, is being bailed out, and I think half of the money that Mexico owned US will wipe out or write off by the Americans. But the other part, especially the Asian financial crisis, they all come from taxpayer money, right? IMF come in and lend them. It's not free money because IMF want back their money too, right? And after 1997, I think about 2001, 2002, countries like Philippines, Indonesia, Thailand, and also Vietnam, they pay out all the loan back to IMF, and the system is robust, right? Bank also have a social development role. Financial intervention, economic growth, promote financial inclusion. This is very important. Financial inclusion means in the early time, there are many people that are underbanked or unbankable. We exclude them, especially in the rural area. But today you cannot exclude them because you have financial technology. Mobile banking is a very good example. And bank now, this is important for bank. Why? They used to exclude this sector of the economy because they are arrogant, big, strong, friendly, Chulai in front. I get the big market. But with competition now, chasing after that, I do a lot of microfinance. In fact, a lot of banks in other countries are offering microfinance to borrower banks, which they don't do at all. Indonesia is a prime example. Infrastructure, development, financial, employment generation, reduce inequality. This is the social role of the bank. I have not put in here lately. You have another role that banks do. The sustainability, the environment, climate change, climate risk. All banks in New Zealand mandatory. You borrow money, big corporation, you had to compete that sector to convince the bank you address all the issue because of liability issue, right? And as we go forward now, looking at all these banks, we have green bank, we have green loan, green finance, green bond. This is one aspect I did not put in there, which I'm still doing a lot of study looking at how climate risk, climate change affects our loans, our deposit. And when I look at it today, you ask any investor, two bonds, traditional bond, green bond, which they like, green bond, right? So that's another role that banks do. Banks are regulated because they must keep enough capital. Why is it important? Solvency. But shareholders don't like it. What the shareholder want? Money sit at the bank, zero opportunity. Doesn't move. And this is the problem here. Every crisis, after every crisis, you had the Basel Accord, Basel I, Basel II, we now the Basel III, come in to change the weight with the asset of the risk of the bank balance sheet to impose them, increase them, so that they put more capital in the bank. We are now coming to Basel IV in that. Right? Liquidity requirement, bank are regulated because they had to put capital in banks so that when you withdraw your money, bank have money to pay you back, right? Prudential supervision, we know whether your bank had to be highly regulated. This is the unique feature of deposit insurance. This came about in the 1930s Great Depression era in America. We have a lot of wildcat banking running around. So after the Great Depression era, the failure of a lot of banks, central bank government introduced what they call Federal Deposit Insurance Corporation, FDIC. If you go to America, you go to every bank, at the door there, they will see FDIC. What does it mean? I don't need to worry. I will get back my deposit. So some countries now have been doing that. And also IMF had told Thailand, Indonesia, Philippines, Vietnam, we lend you money. We want you to create this to prevent bank run, right? Because right now, after the financial crisis in US, the deposit insurance that insure you now went up $250,000 per depositor. Previously is 100,000. This is important. Why? We as saver, you don't put $250,000 in bank and saving there because the interest you earn is peanut. You put your money somewhere else. You probably have what, 10,000, 20,000, 30,000, the most. But if you're guaranteed 203,000, you don't go bank run at all. That's why we feel safe. We trust the bank. And of course, when you misbehave, central bank will come in and audit your book, impose more restriction, making it more difficult to compete with people, non-banks that are unregulated, not regulated, right? And also, of course, today with technology, we worry about this on money laundering, counter-terrorism financing, and so on. And this is what I'll come the next part on this one. So why we need to regulate banks? That's what it is, right? We regulate them. We remove regulation, not only compete. They misbehave. We regulate them again. It's a cycle came on. Professor Kane, Germany is the one professor that came out with this philosophy about dialectic struggle among banks, right? Now, this is the era we are in, digital finance in the future. These have created economies of scale, economies of scope for banks, right? So give an example. And my student laugh. You know, in the village, we have a police station. And previously, they have a small ASB bank there. Next to police station, how sick can you be? Next to police station. And the worst thing is that, ironically, I did go there sometime to do something, ask something. They have 2 security guards in front of the bank too. Next to a police station, how more safe can you be? Or like, wow. I asked a security guard, it's a police station here. He tell me, I need a job, so don't ask. I'm here to protect you. So, okay, I understand. So I monitor. What happened? They're no more there. Foot traffic is not there. You ask yourself, in the Riccarton Mall, previously your ASB bank by the corner side near Farmers, right? You've been to Riccarton Mall. Some people say, wow, you go to Riccarton Mall a lot. You don't remember where the bank is. Huh? The other bank is next to Pack and Save, Westpac. It's now taken by Adidas. No more. So when the bank was going to close, I went and asked one of the manager, why are you closing? We don't need it. Because you folks don't come and see us. And they say, we have another branch in Waimari. We don't need too many physical buildings. You know, it's not like Asian country probably will start to evolve too. Asian country love big banks, especially in China. Bank of China, Bank of China, Bank of China, Bank of China. I look like. And I love to go to all these banks when I'm in China. Why? I like to go and sit and look at all the bank tellers. They have rows of bank tellers, and the bank teller cannot sit. They'll just stand there. Until you go in, they sit. I always look there. You know, sometimes the security can't tell me, what are you doing? He's just observing. But it will change because why? We all are doing online banking, virtual banking, right? Digital, right? Financial innovation allow banks to cut costs, deliver service to you at a cheaper rate. Used to be, we say, you know, during my grandfather, mother time, they say, the bigger the bank, they are big, strong, friendly. President Obama said, the bigger you are, the faster you fall. Which is true because this giant bank take a lot of risks that are very systemic. AI, machine learning, blockchain, all these are important because why? At the end of the day, what does a bank want? Data. Data from business, data from you, and so on. That's why when you look at it, look at this one, is a good example here, right? Credit card losing to who? WeChat payment, Alipay, PayPal. Used to be when you buy anything overseas, you had to use a credit card. Today, WeChat dominated. You go anywhere, WeChat now is acceptable. Used to be when WeChat first started in China, when the Chinese tourists came, they realized that they cannot use the WeChat. They cannot use their credit card called Union Pay because New Zealand Bank has no authority with that. Then they realized we are missing this market. Suddenly, they develop it. Chinese people come in now, they can use a WeChat. They can use a Union Pay anywhere they want. If they don't, somebody will do it. This is why technology is so important and cloud computing. And this is where we worry. Cybersecurity. Central bank has not come up with a very good firewall to protect this. 2 years ago, I went to Mumbai. I went to the stock exchange. But we are trying to develop our fintech and financial master finance with them. And the director took me to the 9th floor. It's a cyber room, big. It's a privilege to go in there. Usually you cannot take people in there because I'm there to sell my programs on. And I walk around, he showed me, and I asked the director, what are all these red dots going on? People hacking into people's account. Yes, or like, seriously? No, look at that. This is from Wisconsin. This is from Hebei. And I say, why is happening? Because we have never had a very good firewall. Because we are still emerging in this big data, big cloud, and so on. You know, people are using it to their advantage where you don't really have a good firewall. So we have to worry and so on. Especially right now, when you do anything in your account, I'm sure if you send money through your account virtually, if your bank notice that it's very unusual transaction, they will send a note to your mobile phone first, say, "Is this the one you do that?" and so on. You know, and it's like this. I mean, a couple of years ago, I was in China teaching, come home, 6:30 coming home. My bank manager called me, Christopher. I say, yes, I'm the best bank manager. I want to let you know, why do you charge $10,000 in Egypt? My heart sank. When did I go to Egypt? I was shaking. $10,000 or like, oh, wait a minute. Here's my passport. I can scan and give it to you. I just came from China. I had never been to Egypt. That's why we call you. We were going to cancel your credit card. We're going to do some checking and we issue a new credit card. Then I said to the bank manager, am I liable for $10,000 in Egypt? No, you're not. Your issues. That is a good firewall. But this one, difficult, right? Difficult. Okay. So digital disruption is the customer experience. All of you, your bank is in your mobile phone. I'm correct? You lose your mobile phone, you can't eat, you can't sleep, you panic. Call me old-fashioned. I still don't use my mobile phone in the bank because I don't trust the system. You know, I'm one who like to look at my dollar before I go to sleep. You know, digital-wise, you know, call me. Sometimes my students say, hey, you teach banking, you're still old-fashioned. Huh? It's trust of this technology. Cost reduction, we all want good service at lower price. That's why the banking service now, why banks charge you a lot nowadays? Because they lose a lot of business to the non-banks, especially in credit card on and so on. And it bothers me. I buy something on a credit card, especially in Christchurch, and the retailer say, you'll be charged 2%, 3%. I'm like, get out here. I just buy something, you charge me 2-3%. It's a bank fee. They give the excuse. That's fine. I go overseas. I use my credit card. I know my bank will charge a fee, right? Because of transaction of the exchange rate. Then the retailer there also will charge me a percentage too. I say, why you do that? I'm buying it for you. It's a bank requirement. It's a bank fee. That's why you see a lot of people now do not want to use credit card. They use WeChat. they use PayPal and so on. Because bank is trying to make money because they are losing a lot their competition to non-bank to all this financial technology. Competition, collaboration, that's why banks like to, collaborate with your power, your, what you call, your rates, everything can pay to online and so on. Cost reduction, right? New product, new service, bank are innovative, coming to try to sell product and services that you never hear about before, entice you into it, right? Of course, there are regulatory challenges for bank because they cannot overdo it because they will be punished, and you have a risk management issue, right? We can minimize risks. We cannot eliminate risks. Inherent risks are going to be in every sector in the financial market, whether we like it or we don't like it, but we try to minimize it, right? If anyone can make a zero risk, let me know. I give you my money, right? Challenges ahead is for bank today is to continue to make profit, protect public interest, which non-bank don't have to do it, right? Then this is a new era coming, climate risk, green finance. And this is very, what do you call, emerging, and China is very aggressive in terms of green finance, green bond. New Zealand just issued a green bond last year, I think, right? And then continuously a competition non-bank, your WeChat, all this, we don't know what other player will come into play and take away part of the bank services, right? Cyber risk threat that is always going to be there, and it's not, Why I don't use mobile banking, I'll tell you why. One day, my friend sent me a message on my mobile phone. It go blank for 10 seconds. Oh my God, what happened to mobile phone? My colleague will tell you, I'm very phobia will come to all this, I think. And then after 10 seconds, it came up with a monkey picture. Got you. Then I tell my friend, please don't do that to me. I have a weak heart. I don't want to die too soon. You worry about that, right? And bank always have to continuous compliance, like all the financial reporting, all the new thing comes in, they have to be there. But it's very complex. Because why? Bank has a way to overcome all these regulatory, they're innovative, going to backhaul and so on. That's why you have financial crisis. And the market is very volatile today. We finished the financial crisis in 2008. We thought we were okay. Then came in COVID-19, which is a health crisis, became an economic crisis. Fortunately, it's not a financial crisis because our banks were healthy, well capitalized. But now we have another crisis, economic crisis worldwide, coming from where is it? We have never know tomorrow wake up of what happened. But we still have talent and skill gap in this area of what they call AI fintechs. I listened to YouTube by Jack Ma. He was giving a public lecture to students, and student tell Jack Ma, Mr. Ma, you and your friend created all this AI everything. So I don't have no job. Mr. Ma said, no, the job will be there. It's just that the job will be different. He said, AI cannot work by itself. It's still new human. Big data cannot work by itself. It's still new human. So there is still job. That's what Jack Ma said, right? In conclusion, banks are vital, banks are unique, banks are special to us, right? It's a splendor, stability, prosperity to our economy. We depend on it a lot, especially payment system, right? Resilient bank means the economy is resilient, right? And if you're a bank that are shaky, the economy, we have seen that through the financial crisis, Mexico, Chile, what else? Argentina, Asian financial crisis, Russian crisis, then your US crisis, right? Hopefully we don't have another crisis. And all banks are now looking at new technology, better serve you and be responsible with the community, right? We all don't go to the bank. We don't. We will not go to the bank if we need to, but we all do our bank virtually, right? So in 1994, Bill Gates said, banking is necessary. not bank. So that time I did not think, what does that mean, you know? Now I realize what it means from Mr. Gates, because he's the guy who do all, all the software words and everything. So, it's like, I to cut the story short, I give this one to my student as exam. Banking is necessarily, bank is not, I say, evaluate. They all look at me like, what the hell are you asking me? Think about it carefully and say, what are you using now? I'm not asking you using paper, I'm asking you using your laptop to type your answer. Suddenly they got the answer, they understand it, they all wrote a very good answer, right? So in conclusion, I supervise a lot of students in this area, in banking, in terms of credit, in terms of microfinance. I wrote books in there. Recently, I edited a book on fintech. And one of the one that I have now is a new student that will work on a thesis looking at rural credit, agri-digitization, multi-level fintech adoption in rural development in China. Another one is looking at opportunity challenge of sustainable economic growth in Pakistan, looking at how digital finance can do that. And one of my students should be finishing soon, role of fintech on financial inclusion in rural Thailand. Hopefully we can disseminate our finding to some journals and so on contribution. And also I have another student looking at governance, sustainable performance, European banks, analysis of climate change risks. And then one student look at how COVID-19 impact Chinese bank performance, right? Also, one of my students finished 2 years ago, sustainable business model for commercial bank, Asian Pacific. Now, this student is special. Not that he is Albert Einstein. His special is that he went back to Vietnam, got a job from a Vietnam university. He just, the bank calling up, say, just come in and talk to us, So he went and talk. Because why? His area is built this model. And Vietnam had no people that understand this so much. And that day itself, the bank manager doubled his salary and said, come to work with me next week. He called the university, sorry, I got something better. And he's doing that very, very well. Because why? He is building this model for banks, the sustainable business model, right? And I have people who look at loans in Vietnam retail bank using artificial neural network, a very complex type of methods. And the student had to take a class with computing, understand that. Banking regulation performance, Chinese bank, capital regulation of bank behavior. So these are types of banking study that I supervise students across Asia. So these are some of my selected publications with my student looking at bank capital risk relation during COVID-19. We have also customer loyalty, Islamic bank. I study a lot Islamic bank. Islamic bank is very different from conventional bank. Islamic bank is based on profit and sharing and based on the Sharia law, very religious and so on. But we talk about haram and halal, my colleague like use, are you haram today or you halal today? That's the bank to do that, right? And we also look at editor for special. I did a special issue on commercial bank, collected about 10 papers in here. And we have one more on capital regulation, balance sheet, and bank capital regulation. I want to point out to this one here. Bank efficiency in New Zealand frontier approach. It's when you do banking study, one thing is very difficult, data. It's very difficult to get the data. I'm fortunate a lot of my students, they are able to get the bank data, especially Chinese data bank. You cannot get it, but because my student parents works in banks and know people, we get it. This one here, where is the one in New Zealand? Here. This one here is Professor Tripp from Massey University. Yeah. Not sure Massey. He has all those data from New Zealand Bank, and we talked to him. He was willing to share those data. So this one was published in New Zealand Economic Paper, right? So in closing, I do a lot of this, but my headache comes in when students see me. The first thing is the data. Then after that, I say, why do you want to study it? What can you contribute, not just to the academic literature, but to the banking industry, the banking sector, what they can do to learn from our study and so on, right? Future, this is one thing I've been exploring. What can I do in this sphere now, right? Fintech, climate change, all my students do it. So modern banks operate in an environment where richness of data is generated, distributed, accessed across multiple platforms, where clients regain increasingly greater control of their personal data, right? So I'm still thinking how to develop a theoretical framework that capture all this data and look at the behavior friction on brand loyalty, switching costs, business complexity. Are we loyal to our bank? If not, we switch. What are switching costs? I want to look at all this data. I want to look how clients strategically review or conceal their personal data, how this affect price banking competition. Explore how fragmented information space influence bank incentive to look at advanced data analytics and how they may affect credit. So I'm trying to talk to one of my newly hired colleague who very good in data analytics and explore heterogeneity among lender, bank, fintech, customer, how customers shape the distribution outcome, social welfare, allocative efficiency of the financial market. I'm still exploring this one. The idea is there, but the question I have, big question mark, is still my data. Because bank data are very confidential, very private. A lot of my study on the credit market is using primary data. And cross-sectional data cannot be generalized. And that's the problem with that, right? Thank you very much.
Banking inquiry, at the moment we see the banking inquiry into banks for this, and Federated Farmers are complaining about our local banks, and it's looking at pushing an environmental agenda onto people who want to borrow money. I think the farmers. How do you So banks, the Federated Farmers, yeah, Federated Farmers. Yes, sorry, the Federated Farmers are accusing the banks of being woke, of pushing an environmental agenda onto the banks. And you're saying one of their goals is in the sustainability. Well, I just wonder what your thought is about this and the push for a banking inquiry in New Zealand.
That is the biggest problem, that challenge to I look into it. I ask myself, especially when banks start putting this environmental requirement into foreign capacity, and will borrower then will greenwash. Say I put it on a paper, but then don't do it. It's a challenge because why then the cost of borrowing become more expensive. When you start thinking about the liability issue that the borrower can attach to the bank, and to the loans and so on. But there is no strict well answer here, because I've done some study with my students. We look at in terms of bank imposing that environmental due diligence before issuing the loan. So the borrower will quickly put in the books and everything, but then we do greenwashing. This is the biggest problem too, and this is the challenge for both sides of the coin. Because if you look at it, for example, we look at Exxon Monkey that Blue Alaska. Question is, who paid for it? But not only that, about a couple of years ago, the BP did that to Louisiana coast, Mississippi Gulf. And today, the oyster had not recovered. And the farmers say they blame the banks. And that is a question that I don't have an answer yet. But it's a question that I still ask. How legitimate is it going to tie to the both sides of the coin, the lender side and the borrower? I mean, the lender has to do more monitoring, more evaluation, then the cost of the goes up. Not just the interest cost, but the service cost. How much expensive?
Other question.
Christopher, your research seems to be based on prices. Is that and understanding of what happens?
Yes,
There is a major perturbation. Is that how you?
Yes.
How you see it?
because I look at it like when I was a student, I think my professor, who was a famous professor, Professor Whare in that area, always tell them the goodness of bank, this and that. Then when I start doing research to look at prices, like, okay, when one prices, why we still have another prices instead of re-regulating and so on. And I explore, then I found out that our friends are very good with innovation to overcome that regulatory laws and move behind the ball and everything. But good example is the 2008 financial crisis where central bank was caught off guard. The bank offloads all the housing loan, credit card loan, and secondary investment. And it was not on the balance sheet. So then central bank say, no, on the balance sheet, you are not going to pay the central bank. But the problem is, the bank take risk, they don't care, they take over excessive risk. So, another thing that I look at it is I'm trying to figure out the banking culture in Japan. Right? Japanese people don't like to put money in the bank. They like to put under the mattress. I thought with some Japanese people, I said, why? At night, I can't. Morning, I wake up, my yen is very warm at night. I put my bank tomorrow. I went to so when I went to Japan during my sabbatical, I went to the bank. Most of it very nice. Bank manager, I want to open an account. Bank manager say, yes, but you're going to pay a fee. But get out here. I'm opening my account. You charge me fee because you put your money in the bank. It will be very safe. So in Japan, you open an account, they charge you. Because why? There are limited depositor who do not trust the bank in Japan. But the Japanese bank are known for kiasu, where they are very dominant on doing a lot of things like with all those car industry, just like the chabo in Korea, with the steel industry. So, and they don't have insurance, bank go bankrupt. You know, you can ask some of my Thai students, do they trust the Thai bank? They laugh a bit because they've gone through a very painful financial crisis period. You ask my Indonesian students, do you trust the bank? They went through a very painful financial crisis where they almost think they lose all their money. That drives me motivating. I still want to find out, despite of this direct struggle, bank understanding, still and one of the answer is moral hazard. You keep telling out, you keep protecting them, we don't behave, they go away. Obama is a good example when Lehman Brothers, the night, Bastion was being bought up by mutual one and so on. And then Lehman Brothers was his investment bank. They were so involved, the CEO, don't worry. Don't give up. So next morning, Obama said, no, the bigger you are, the faster you fail. He's trying to send the right signal to the market. It's like risk bearing responsibility.
Christopher, thank you for your presentation today on the uniqueness of banks. It's been revealing, particularly the journey into fintech and where that sits. You've obviously inspired a huge number of students. I think many are here today. That's come through in the presentation, through the research, and thank you very much. Thank you very much for your time. So, a little bit of silence. Please feel like that's an apoio, so